Now speaking, Sam Sato, President and Chief Executive Officer. The company reported strong demand for spring and summer collections and good progress on growth initiatives. Fiscal 2023 business is off to a good start with net sales increasing from last year, an increase in total customers, better inventory and stock positions, and conservative business planning providing flexibility in go-to-market strategies. The company rebranded Duluth by Duluth Trading Company and AKHG to serve its customers' distinct use cases. Their garden, landscaping, and planning collection was up nearly 30% compared to last year, while the AKHG men's and women's collections were both up 43%. The company also looks to expand into other categories through development or acquisitions. First quarter results include net sales of $123.8 million, a net loss per share of 12 cents, and positive adjusted EBITDA of $5.3 million. Inventory levels ended the quarter down 5% from last year and 6% from the fourth quarter. Price and basket sensitivity due to macro pressures has been seen, yet strong unit sales growth of 6% over last year was reported. The marketing strategy around college basketball and March Madness drove an increase in web visits, new buyers, and sales in key categories. The first annual Do-It-All Days event featuring special price select seasonal categories followed. Website replatforming resulted in a higher conversion rate and direct sales growth of 2.5%. In-store traffic remained challenged, but heightened selling efforts drove an increase in units per transaction and shopper conversion. Lastly, the Southeast Fulfillment Center in Adairsville, Georgia is on track and on budget. Now speaking, Dave Loretta, Chief Financial Officer. The Quarter 1 earnings call reported net sales of $123.8 million, up 0.7% from last year. Sales in the direct channel increased 2.3%, with higher conversion rates across mobile and desktop. Retail channel sales were down 2.1% due to lower store traffic and customers responding more to items on sale or clearance price, resulting in a decrease in average unit retail. Gross profit margin was 53%, compared to 54.6% last year, due to the mix of full-price sales being lower than last year and deeper discounting. SG&A for the quarter increased 3.2% to $70.2 million, which included a decrease in advertising and marketing expenses, an increase in general and administrative expenses, and an increase in selling expenses. Advertising and marketing costs decreased 80 basis points to 9.2%. Adjusted EBITDA for the quarter was $5.3 million, compared to $7.9 million last year. Net loss per share was 12 cents versus a loss per share of 4 cents last year. The company ended the quarter with net working capital of $89 million, including $9 million in cash, and a total capital expenditure plan of $55 million. Inventory balance was down 5% from last year. Guidance for fiscal year 2023 includes net sales of $645 million to $660 million, gross profit margin flat to up 20 basis points, SG&A expenses flat to down 20 basis points. $36 million in depreciation and amortization expense, adjusted EBITDA of $47 to $49 million, and EPS of 2 cents to 8 cents. DIG analyst Ethan Segee inquired, could you provide more details on what drove the acceleration in the men's business in the first quarter and your plans for inventory levels in the second half of the year? Sam Sato replied, thanks, Ethan. We are pleased with the significant improvement in the men's business from the prior quarter. Consumers have responded positively to our seasonal fabrics such as Dry on the Fly, Armadillo, and Breeze Shooter, which have helped our year-round goods remain competitive. We are continuously innovating and finding new ways to bring him into the store or online, particularly as discretionary spending has been more challenged. Overall, we are pleased with the progress and acceleration of the men's business. Dave Loretta replied, in response to the inventory question, we are on track with inventory levels coming in below last year. We saw a 5% decrease in Q1 and expect mid-single digits for the remainder of the year, reaching 10 to 15% lower than last year at the end of the year. This is due to our successful adjustment of the inventory flow given business trends. DIG analyst Ethan Segee inquired, could you provide an update on the sales cadence between Q1 and Q2, and how consumer cautiousness has impacted your performance? Dave Loretta replied, the first quarter for us was a bit soft in February, but we saw improvement in March and even better results in April. This allowed us to have a slight positive overall top line. Despite this, there was still margin pressure due to customers looking for deals. However, our innovative garden and swim collections drove the increase in sales, giving us the positive trend we're currently enjoying. Robert W. Baird & Company analyst John Comp inquired, "Could you please explain where you are seeing the most price sensitivity in your stores and online, and how do you plan to address it?" Dave Loretta replied, "The sensitivity to pricing, John, is generally consistent across the board. Men's has experienced it a bit more than other categories. This is largely due to the continuation of the back half of last year. Seasonal items have seen better promotional outcomes than those that are year-round." Sam Sato replied, "Jonathan, we believe our brand remains strong. We saw 6% growth in unit sales for the quarter compared to last year and 43% growth in our AKHG brand, as well as 14% growth in women's items. We're managing our inventory purposefully, down 5% from last year, with a good stock position and a well-balanced mix. We'll remain competitive while being mindful of generating top-line and flow through to profits, without sacrificing quality or chasing unprofitable sales." Robert W. Baird & Company analyst John Comp inquired, "Can you provide an update on full-year guidance in comparison to fiscal 2019? What factors give you confidence in the 10 to 12% revenue growth range? And why is it important to consider acquisitions or adding complexity to the business model?" Dave Loretta replied, "Regarding our sales guidance, we feel confident that it is reflective of the current trend and will continue to be in line with our annual guidance. We do not anticipate any significant changes in Q2, 3, or 4. As for the acquisition, Sam can provide more insight on that." Sam Sato replied, "Acquisitions are part of our strategic framework and we have established a target profile to vet potential opportunities. We are not currently looking for acquisitions, but we are positioning ourselves to capitalize on them should the right opportunity arise. We would use acquisitions to expand our distribution channels and build or acquire new brands." Robert W. Baird & Company analyst John Comp inquired, "David, can you clarify if you are assuming a consistent trend in the current fiscal year to reach your guidance?" Stifel Financial Corporation analyst Peter McGoldrick inquired, "Could you talk about the makeup of your newer customers relative to the Heritage Men's Duluth customer? Are there any differences in promotional engagement, basket size, or frequency of purchase?" Sam Sato replied, "Peter, this quarter we saw great success with the younger customer base and female customers. Our Big Dan blueprint targeted 40 to 50-year-olds and we saw nearly half of our new customers in Q1 were under that age. We have always had a strong female customer count, however, the percentage of total women's business was lower than expected. We've made investments in how we market to her, our stores and other channels, which is now paying off in our results." Stifel Financial Corporation analyst Peter McGoldrick inquired, "Could you provide an update on your wholesale distribution aspirations and how it will drive revenue this year and beyond?" Sam Sato replied, "Wholesale is an area that we are currently testing and learning in. Our Tractor Supply partnership is the main focus of this infrastructure investment strategy. The Adairsville Fulfillment Center, which will be fully automated, allows us to distribute directly both to consumers online and to our retail store inventory needs. It also enables us to service wholesale accounts with potential for significant growth for our brand. We will need to invest in personnel and other components to fully realize this opportunity, but strategically speaking, our investments in the back end are designed to enable us to do so." William Blair & Company analyst Dylan Carden inquired, "Could you please provide an update on the total capacity utilization of the center for the holiday period and how it impacts your margin outlook for the year?" Sam Sato replied, "Hey, Dylan, this is Sam. Adairsville will handle 50% of our direct sales demand and has greater capacity than that. We're ramping up and reducing more costly labor-driven CPUs in other fulfillment centers, which will lead to greater efficiencies and should be reflected in the fourth quarter." William Blair & Company analyst Dylan Carden inquired, "Can you elaborate on the expected benefits from the recent changes you implemented?" Dave Loretta replied, "We anticipate roughly 20 to 40 basis points of leverage in our selling expenses this year. We expect to see that leverage increase once we are operating at full capacity throughout the year." William Blair & Company analyst Dylan Carden inquired, "What initiatives have you taken to increase marketing efficiency and promotions, and what opportunities remain for further cost savings?" William Blair & Company analyst Dylan Carden inquired, "What opportunities do you see to make promotional and marketing activities more efficient in a normalized period?" Sam Sato replied, "The sensitivities around price have continued into Q2, and we had hoped to see a reduction in promotional activity. However, our team has done a great job of planning our purchases and receipts, so while we must remain competitive and address consumer headwinds, we are not in a position of chasing unprofitable sales. We anticipate that Q2 will remain highly promotional with price and basket sensitivities from the consumer, but we will be purposeful and selective on how we cadence our promotional activity." Dave Loretta replied, "Our marketing efforts have resulted in significant savings this year. We have seen a 100 basis points of leverage on flat to slightly increased sales, over $5 to $6 million in reduced ad spend. This is largely due to our efficient processes and the shift away from linear TV consumption towards digital media and streaming." Sam Sato replied, "In addition to leverage, our brand marketing team is driving efficiency and affecting our spend. It's a complex holistic effort from creating brand awareness to conversion tactics, balancing long-term brand health with near-term sales. Our team is identifying where consumers are engaging with us and allocating dollars, flexibly adjusting their spend almost daily as results come in. We saw this during March Madness, where big bets translated to ongoing awareness and conversion opportunities." William Blair & Company analyst Dylan Carden inquired, "Can you elaborate on the opportunities for growth within the work category, and how that might impact seasonality and promotional needs of the brand?" Sam Sato replied, "Product innovation is essential for our business, and we are committed to finding opportunities within the Duluth workwear space. We have seen growth in the garden bib overall and now have expanded into other silhouettes and genders. Additionally, acquisitions can provide an opportunity to address adjacent consumers and broaden our customer base beyond just workwear and outdoor rec."